everyone. It's good to see so many people here braving the cold weather to join us. Thank you. So my name is Greg Brown. I'm a partner in the finance team here at A&O Sherman. So I'd just like to take this opportunity to welcome all of you joining us here tonight for this event. We're very pleased to be able to host this, very pleased to be able to support the Financial Inclusion Forum and the London Impact Investing Network. So I've been part of the social impact group here at this firm for the best part of 2 decades now. But one of the things that's been most noticeable in the last 5 years or so is that so much of the language and the concepts that are used in the world of impact investing has sort of crossed over into my day job of sort of normal finance. So the vocabulary and the concepts are now part of the day job as well. And that's been a really interesting, really enjoyable change, and it does just demonstrate the further potential and the interest in the space that we're going to talk about tonight. So without further ado, thank you again for joining us here tonight. So with that, I will hand over, I think, to our first speaker. Thank you.
Right. Thank you very much, Greg. We are incredibly grateful for A&O Sherman's generous hospitality, which you will all get to experience and enjoy in the course of this evening, allowing our content and our community to connect with each other in person. And worth mentioning also for our governance processes to be in great shape, thanks to Rory Copeland as our valued board member over the past several years. A very warm welcome to everyone present here this evening. It means a lot to us to see the room so well filled, despite viruses running rife at the moment, and experience the high demand for our event. Being in this room means you are part of a special evening that we encourage you to utilize well. As Financial Inclusion Forum, also known as FIF, we have built a diverse and meaningful community of morally ambitious people over the past 20 years. With its roots in microfinance as one of the earliest forms of impact investing. So be prepared for this to be a transformative evening, as you wouldn't be the first one to reach a pivotal moment in your career after attending one of our events, which is what happened to myself 12 years ago. My name is Lotte Thelen, your host for this evening. In my day job, I work for Morningstar Sustainalytics, serving institutional investors. And alongside this, I have been board member of the Financial Inclusion Forum for the past 5 years, having spent the early years of my career advising and funding banks in Africa. You may have wondered when you entered this evening why you did not get given a name badge. And this has actually been done on purpose. It was convenient as well, but it was actually done on purpose. And that was to create a level playing field and to encourage everyone here to connect with each other with an open mind. To give you a sense of who we've got in this room, though, I would like to do an old-fashioned raise of hands. So please could I ask you to raise your hands if you are currently working in impact investing. That's a good amount. That's probably about half. Great. If you would like to get into or you are curious about impact investing. Similar amount. Great. Very good. Pleased to have you all here. If you're working for a bank or an investment firm, decent amount. An NGO, policy, or academics? Brilliant. Always delighted to have you attend. Are you mid-career? I know, we have to make that call. No judgment made. Early career, or perhaps student? Fantastic. Late career, or perhaps even retired and still engaged? I see some happy smiles, very good. Great. Has any one of you been to a LIN event, a London Impact Investing Network event before? Exciting, very good. Very pleased to have you all here. And a FIF event, a Financial Inclusion Forum event that you've attended before? Some obvious hands, but great to see you all here. That's brilliant. Okay, that hopefully gives a good flavor of what the room's like tonight, but really the encouragement in the end is to connect with each other, because that's, of course, besides the content, that's what this evening is about. This evening we offer you a carefully curated program, which has been driven solely by the objective to create inspiring content for the benefit of the greater good, and to fuel the moral ambition of the city a little bit as well. In partnership with our friends of the London Impact Investing Network, Ian here in front of me, who have gained fantastic momentum over the recent years as a group, we have looked to cut across the spectrum of impact investing in order for capital to be directed towards the most impactful and the most lucrative strategies. In the first edition of this event back in 2022, which was called 50 Shades of Impact, we recognized the complexity and the nuance of investment for positive impact, and we delved into the realities of a number of established asset classes. Building on this, tonight we will be exploring the potential of impact principles to lead to alpha generation, also known as outperformance, basically driving excess returns. From there on, we will be delving into investor appetite for social impact, how investable impact is, and how this matches the funding needs to address societal challenges present. Right, first of all, however, we will kick off with a fireside chat about CFA UK's latest edition, the Certificate in Impact Investing, giving you exclusive insight into this promising new certificate. So I'm very delighted to hand the floor to my counterpart Ian, and no one less than Will Goodart as CEO of CFA UK.
Thank you.
Hi, good evening everyone. My name is Ian Povey-Hall. I'm one of the founders of the London Impact Investing Network. I'd like to second Lottie's thank you to A&O for hosting us today. Slightly larger and more salubrious kind of home than we're normally at, but it's fantastic to see so many people coming to our events, so thank you. I'm also the director of House of Impact, which is a startup platform dedicated to scaling impact funds and companies by connecting them with great people, clients, and capital. Will, thanks for taking time to give us a quick 10 minutes and talk about the certificate in impact investing. I was hoping you could give us just a bit of context in terms of the certificate, the origination, and kind of how you've seen it evolve over time, and what was maybe the driving force to putting it out there off the back of the kind of the ESG certificate, which is obviously taken up by a large portion of the market a few years ago.
No, of course. Thank you very much, and it's great to be here, and delighted to have the opportunity to talk at another LIN event. I know it's a joint event, but there's slightly more people than have sometimes been at LIN events in the past, and I do remember going to impact events sort of 5-10 years ago, and there'd be 20 of us in a room. We all knew each other quite well then, and it's lovely to see some faces that I don't know, and to see the growing interest in impact, and actually to echo Greg's opening comments. I guess I'm up here and CFA have an interest in impact because impact has crossed over into what Greg referred to as normal finance. It is now part of mainstream financial activity. It may be slightly over to one side of the range of those activities, but there's no question that impact is increasingly important to investment decision making. I don't think that we're yet quite at the point where it's risk, return, and impact, but the fact that people talk about living in a world and working in a world where it is risk, return, and impact, and not just risk and return, is really interesting. We used to think about that as a sort of kind of a hope and a sort of a fond hope. But actually, I think we're much closer to that being a reality than we were before, which is very exciting. So you wanted me to talk about sort of the origin of it. I mean, I suppose we got to start in thinking about sustainability and how do we educate people on sustainability with a certificate in ESG investing, which we launched in 2019. We'd been working on for a couple of years, and so I think we were sort of quite quick to the market. But even then, we knew about impact. I'd worked with Dame Elizabeth Corley on the growing a culture of social impact investing in the UK. That then recommended the development of the Impact Investing Institute, and I've been on the board of that since 2019. And all along, we were very keen to promote a greater understanding of impact investing. And we developed the Learning Hub at the Impact Investing Institute, which, if you haven't visited already, is a really fabulous resource. And actually, at some point, fairly soon, I'm probably going to be going out and looking for volunteers to help us update that, because we need people who know what's going on in different parts of the market to help keep it current for everybody else. It's one of the nice things about impact investing, actually. It's still sort of a community activity rather than necessarily an industry yet. But nevertheless, it's also exciting that it's moving towards an industry. I'm also conscious that I've spoken non-stop for about 3 minutes and not give you an opportunity to ask me any questions. But
well, I mean,
sorry.
just going back to the certificate, I guess kind of, for anyone who's, not come across it or read about it, how would you kind of summarize it in terms of a process for somebody to go through and why it exists?
Sure. Impact's a sort of a strange thing, because even those of us who've been sort of working in and around it for a long time are never quite sure if we know exactly what it is and everything that's going on, and how all the different pieces of the puzzle work. And I suppose CFA, again, for people who don't know what the CFA is, CFA stands for Chartered Financial Analyst, and it's a professional body, and we run the CFA program, which is very well known. And what we try to do, our mission is to educate, connect, and inspire the investment community to build a sustainable future. And part of what that involves is thinking about, well, what do people need to know? What kind of skills do they need? What kind of behaviors do we need to engender within those who are going to work in the investing space? And a lot of what's in the certificate in impact investing, which is the official training manual for which is here, is sort of additional to, and everyone here will know what additionality is, but it's additional to an understanding of finance. So to some extent, people need to have an existing understanding of in finance and investing, and then want to layer the impact piece on top of it. And we brought together, the way we always work is to get people who are in the sector together to help us understand what would they think that somebody who'd been working in impact for maybe 6 months to 12 months, what kind of knowledge would that person have at the end of that period of time? What would have accreted to them just from their sort of contacts and reading and working? And then what we try to do is stick that in a program that might take you a month to read. So we're giving people a year to get up to speed and be ready to go into an organization and really work and deliver value more quickly. It is not a program or a certificate that denotes expertise. It denotes an understanding of the full spectrum of impact investing activities. It does not suggest that anybody is an expert. You only build expertise from real practice. This allows people to get into practice or to faster, or to practice slightly better if they're new to it. We have wonderful people, Rebecca MacDonald at Better Society Capital, Avita Zanuso, who led our panel, but there was a panel of, I think, about 15 people who worked on the design of the syllabus, and then we have 10, 12 different authors. So each chapter is authored by somebody who is an impact investing professional, but also is used to working with people who are not working directly in impact investing, because it's not designed to only appeal to people directly in impact investing. It is designed to be useful to people across an investment organization who need to understand impact investing. So they might be working as in financial advice or private banking, but they could be working in a distribution team or a product development team or a client relationship team, any of those sorts of functions. And that's very much what we saw with the certificate in ESG investing, where actually 75% of the people who have registered for that certificate are not already CFA charter holders. So these are not programs for people who would necessarily have deep levels of expertise elsewhere. It's more generalist. It's helping people to get going, to make a start.
Which beat me to my next question. I think there's a lot of
Yeah.
preconception that it's only worth taking it if you want to be an impact investor or fund manager, but actually there's a lot of value in there for people in wider.
Yeah, I mean, I think
management role.
what we try to do is to give people a sort of an end-to-end understanding of the impact investing process. So actually, if you're a lawyer, quite helpful. If you're advising impact investing firms, or funds, if you are, sure I can think of a lot of other different sort of opportunities, but you don't have to be, you don't have to be an impact portfolio manager. You could also be somebody who's trying to source impact investment, but you want to understand, how impact investing works and how impact investors look at the world.
Yeah.
Well, this is a pretty good way to get that kind of sense.
Can we go on the next slide just quickly?
Sorry.
What's in terms of what's the time commitment and how would you see someone being able to do this relative to full-time job, etc.?
It's pretty light, actually. I don't know if there are people in here who've taken either our investment management certificate, the IMC, or the certificate in ESG investing. It's probably a little bit lighter than both of those, and it has a sort of similar pass rate. Our intention is not to weed people out, which is something that the CFA program probably does a little bit more. This is to sort of give everybody a bit of a leg up. And so, we say it has to be 100, it is quite specific, about 131 hours, which is, I know it's odd.
Yeah.
I know it's odd, but it's a requirement of Ofqual that if you want to sort of say that you're at a particular level, it has to be to take 130 hours to study. I think if you read it very, very slowly, it probably would take 130 hours.
The extra hour to be 131 is
exactly
crucial.
Exactly. But I think it probably takes quite a lot less than that. If you go, there's quite a good chain on Reddit, actually, if you look it up. If you go to Impact Investing Certificate on Reddit, somebody spends quite a long time providing advice to other people about, and they say that it took them about a third of that time to study. I think that's probably quite brave, but I wouldn't be surprised if it was more like half of the actually advertised time is probably quite realistic. And if you know a great deal about impact investing already and simply want the badge to put onto LinkedIn, then you would need even less time. A good way, I suppose, to get a sense of whether you think it's for you is we have if you look at it online, there's a sample chapter. You can download the sample chapter, read the sample chapter, and if you find that there's a good deal in it that you think is either well written or sensible or thoughtful or that you didn't already know, then maybe. But if you sort of think, I knew all of that, then maybe it's not for you because you know it all. But
I think there's always something to learn. But thank you very much for coming down and giving us some insights into it. We also have Praneet here. If I'll make you stand up and raise your hand. So Praneet will be around in the networking sessions, and if you'd like more information or
yes, and I'll be around sort of throughout. So if anyone has any questions, delighted to take those. But very much looking forward to the panels. So,
brilliant.
Thank you.
Thanks, Will.
Cheers.
So thank you all for joining me and blessing us with your time and being happy to discuss what I thought would be quite a controversial topic, but I think having unpacked it with each of you, hopefully there's some really interesting insights we can share, and it'd be good to obviously understand more about your various journeys. We're just chatting on the side of the stage, and I don't think any of you started a career path that was destined for impact investing or even investing to some of you, but here we are. The first thing I really wanted to kind of to understand and get your views on is from a bigger picture perspective. How do you think about impact principles as a kind of driver of investment performance? Do we start with you, Ben?
Yeah, why not? We consider impact integral to targeting and delivering better risk-adjusted returns. And our impact at Osmosis is just purely focused on the environment. We try to get multiple levels of impact. So first and foremost, as an asset manager, my fiduciary responsibility is managing risk ideally delivering excess return at the same time. Secondly, the environmental impact is key. We aim to target and deliver significantly reduced environmental footprints of our portfolios relative to respective benchmarks. And then thirdly, we use the power of stewardship, so engagement with the corporates that we invest into, predominantly actually to get them to disclose their environmental data, because we believe if they disclose it, they manage it. And if they manage it, although we live in a slightly topsy-turvy world at the moment, one would imagine if you're managing it, you're managing to reduce it, but who knows what might be happening in North America over the next 12 months or 4 years or so. So those are kind of the three key areas, but fundamentally we do believe, and we have evidenced over 17 years now, that environmental impact leads to financial return, which then consequently enables us to have the power of engagement through the size of the assets that we now manage.
Thanks, Ben. And moving to you, Jen, and obviously kind of with your journey coming through the development finance route, and then I think being the first person at EQT with impact in your job title, really keen to get your views on kind of how that lens is then applied to an investment process from your perspective.
Well, maybe it's best to start with describing for the audience what EQT is and who we are as a firm. So we are a GP, we're an asset manager investing only in private markets, but with 3 different business lines. So we invest in private capital, which is everything from venture capital all the way up to large cap buyout. We invest in infrastructure and we invest in real estate. We have about 250 billion under management, so it's a very large portfolio. And your question around impact principles is, fortunately for me coming in as head of impact into EQT, is quite baked into the way EQT thinks about investing. And just for clarity, when we think about investing and impact investing within the context of EQT, we're setting aside all the work that we do around operations and focusing on how companies operate. That's been long-standing kind of bedrock for the way EQT invests. But instead, we're looking at how we're targeting our capital behind solutions. And those are typically thematic solutions, either focusing on climate and nature, or health and well-being, or access and equality. And we have quite a sharp rubric of what themes we invest behind. And in terms of our core and labeled impact funds, we started with a flagship fund about 2 years ago, which is when I was brought into the business, called EQT Future. And it closed earlier this year as a little over €3 billion fund, investing in the large cap mature business space. And when you're thinking about how can you drive impact in companies that have been in business for decades and have already been operating, the answer is, what can we do as an investor to identify potentially new products and services in those businesses that can pivot them towards more impactful, to delivering solutions that are more impactful and provide actual outcomes in industries, which can then, in theory, and we're already seeing in practice, actually change the behaviors in the industry. And then the other opportunity we have is to move businesses that already have very impactful products and services into new markets or into new underserved business segments. And all of this, I think to your point around alpha, is collinear with the business case. And I think when we're talking about principles of impact, we're talking about, particularly in the mainstream investment space, looking at what are the long-term mega trends. And arguably, companies that are delivering sustainability solutions across the piece are going to be the companies that are going to be in demand in the future as the system starts to demand and require more solutions for decarbonization, for talent management, diverse talent management, for access to all kinds of basic services that the private sector is playing a larger and larger role in.
Thanks, Jen. And Peter, last and not least, keen to get your view as someone who comes from, should we say, the dark side of hedge funds. And then, Peter got referred to me a few years ago, and I would say, maybe not reluctantly, but ambivalently, I've persuaded him to come and kind of just talk about what he's been able to achieve and how that kind of journey's been for the last 10 years. But yeah, keen to get your perspective of just kind of how you view the word impact and maybe how you view it now versus, I don't know, 15 years ago, maybe it wasn't on your radar.
Yeah, I mean, the hedge fund industry, which I started in 1990s, actually, so quite a while back. And I kind of rode that whole wave of let's say, a market that wasn't known to an institutional market. It went from coffee shop to institutional. In 2010, I was lucky enough to be a partner in a hedge fund. We sold it. And I had a bit of money, and I spoke with my partners who sold it, and I thought, you know what? I think now we're in a good position. Why don't we look at investing in the environment, which had started to come into the public space, and social. And
sorry, was that kind of origination from a values perspective?
yeah,
or was it an
totally. I
opportunity?
mean, we were just lucky. I mean, you know, when you're lucky enough to sell a business, you have your own money, you're sitting there, and you go, what now? So you have a almost blank piece of paper. And we thought, okay, let's try this. You know, and we quickly realized that, and this is real impact, if the impact industry was going to grow, and it had to grow, because we've got a big need, environmentally and socially in the world, we had to find a way to bridge the real money which we know was out there into this area. And because we came from the hedge fund background, we knew performance was the only way. So at that stage, it was, okay, how do we now go and take this on? So we decided, okay, let's go and prove that we can be a top quartile private equity fund. This is 2010. And then we can show everyone that it doesn't matter the word impact, you're getting real return here. From 2010 to 2013, I can safely say we failed. Impact was a lot harder, basically because we were very much a data-driven hedge fund, and the data wasn't great, so our investment choices weren't great. But there seemed to be this, and we're going to I'm sure we're going to talk about this great, almost maniac thing about carbon credits, which was taking away from what environment and social really is. And then in 2013, I reached out to the late and great Charlie Munger. I was an investor in Berkshire Hathaway. And I basically wrote him an email. I said, look, have you got any suggestions? You know, because I want to do and prove to everyone that you can make as much money in environment and social as any other area. Strange enough, I got a phone call about 3 days after that email. It was him. And he goes, I don't believe in this environmental thing. I said, okay, thank you. But he goes, but look, if you're going to do it, I'll give you the same structure we used at Berkshire. Look at income and look at capital appreciation as two separate buckets. And he said something else to me. He goes, at the end of the day, it doesn't matter whether something's environmental or social. It's a business. And it's the same principles of investing in any type of business. So his advice, which we kept to, was separate our analysis from the business to impact. So this goes against, I know, everyone. So that's what we do. The first question we always ask, right, is what is the impact environmentally or socially of this business we're looking at? And it's private equity, by the way. If it passes our tests from an environmental and social perspective, we then put on our old hedge fund hat and go, what do we think about this as a business? And that does lead, I must admit, because it is a new area, to us rejecting a lot of investments. But what it has proved to us is it's made us creative, and creative how we exploit our portfolio. Again, I've got to say this, right? I'm in a very fortunate position. We don't have clients, it's us. We can do what we want. And that gives us tremendous flexibility in this space. But we managed to get a formula. And from 2014 to today, I think we're a top quartile private equity returning fund. I should also say social, and people always forget social because we can highlight it on the environment. we actually discovered the best way to socially invest is to give. And that's what we do. So we kind of lessened our social investment, or trying to find that, and just donate as a charitable to social causes. So we're really an environmental returning fund that donates to social.
Thanks, Peter. And so kind of the next what I'd like to talk about with each of you is kind of picking a particular product or strategy, or I guess in Ben's case, the business with osmosis, how you've taken that from conceptualization through to obviously having the track record it has today, and kind of what learnings you have. And I guess 17 years ago, you were kind of out there on your own in terms of that. And if you don't mind me saying, it's quite a it's been quite a steep curve in the last few years, but there must have been quite a long time where you might maybe even question actually, if you're too far out there, as it were.
I still question that today, to be honest. It's, every day it seems just to get harder, to be honest, not easier. But yeah, so we launched 17 years ago. My background was not in finance. I built a tech firm and sold it. So I was lucky enough also to have a liquidity event, and I really wanted to go and have a surf school in Costa Rica and not engage in city life ever again. But I watched the Al Gore movie, which was my trigger,
Right.
and young children. And I thought, okay, I want to put my money to work on an environmental basis. We hadn't met, otherwise I may have just given it to you.
We don't take outside money. Sorry.
But I came out to the city to review fund managers who at that point, and indeed lots of them unfortunately still today, just had one thing in common, which was a very confused investment methodology, massive underperformance, and charge a lot of money for the pleasure of taking your money. And I thought, there's no way I'm going to give my money to these people just to buy a new Porsche every year. I'll set up my own firm and see if I can build something that can be low-cost, liquid, so be systematic and quantitative, so it's highly scalable, and data-driven, focused on the environment. And if I would buy it myself, then maybe I might be one of the most stupid people in this room, but I'll certainly identify other stupid people to follow along behind me. And that was really the birth of osmosis. So the first thing was identifying data. We wanted to just prove out something very simple, that across the whole economy, so across 32 sectors of the economy, those companies that produce more economic value, that's rooted in pragmatism. We need global growth. We like lifting developing nations or emerging countries into becoming more developing nations. We shouldn't penalise countries for that through sustainability, which a lot of funds do. We wanted to target on a sector relative basis the identification of resource-efficient companies. So if you produce more and consume less, could you prove out that that's a proxy for quality management that's yet to be priced by the market, so the source of alpha? And to do that, we needed to find data, and data is still today the bane of every asset manager's life. It's poor quality, it's subjective, it's riddled with estimates driven by very poor estimation models. So we had to make a very expensive decision that if we're going to do this and be accountable for the risk that we manage, because unfortunately a lot of sustainable asset managers are not very ethical themselves. Got a bit of a grudge to bear here. They charge still a lot of money. If you go to Morningstar, I think someone here introduced us from Morningstar. Sustainable, yeah. So if you go to Morningstar and go to sector ecology and look at the public equity returns for a climate ecology sector, there's no way you're going to give your money to 98% of those funds, or I advise you not to, because they're all down 15, 20% year to date. Their 3, 5-year, 10-year numbers are all very poor. So I wanted to solve for that problem. Just by proving out this quality argument. Good quality management should manage their environmental balance sheet and their financial balance sheet. And if you can do that and quantify it, put it through risk optimizers and build nicely broadly diversified portfolios, don't run too much risk, because you run too much risk, obviously you can get higher returns, but as the asset management industry, they target lots of risk, and they tend to, in the main, I think 75% of managers underperform their benchmark on a 5 and 10-year basis. So you just got the opportunity to lose more money, while again paying people handsomely to do that for you. So low risk, high capacity, low cost, low price strategies driven by this very objective, quantifiable process, all built in-house and proprietary. And we launched that first strategy in 2011 with no assets. It was my money. The seeder ran away a mile once he'd committed, and we were about to launch the fund, and they ran away because the community, unfortunately, in asset management is also not that ethical. Surprise, surprise, it's finance. So we had to seed it ourselves, and then we thought, what a great idea. That's the other thing about sustainability is it's just common sense, isn't it? Who wouldn't want to invest in environmentally leading companies that made you more money and was low cost and liquid? Well, it turns out everyone. Until you've got a 3 or a 5 year track record, or you're running 500 a billion, or in the case over here, 250 billion, you need scale. So the barriers to entry are high, the cost of operations are exponential and growing. SaaS is the evil amongst us all. They say inflation's coming down, but when all their pricing is inflation plus 5%, I don't think inflation's ever coming down to where to below 2%. That's another gripe. But anyway, so we built the first portfolio. We had no money. We went out. We spent 3 years educating investors. I became a school teacher, roaming the world, telling people, about this great idea and just getting told no 1,000 times. And then eventually, I started finding the exceptions that proved the rule. And the first one was the Oxford University Endowment Fund, who I think just got bored of me calling, to be honest, and eventually took a meeting. And they said it was fascinating. I actually stepped over students chained to the radiators in their lobby on the way into the meeting who were protesting about their oil and gas holdings in their portfolio. And I thought, if there's ever a shoe-in to raise money, today is the day.
Good time, yeah.
So I got in there, and the CIO, the CEO, who now sits on my board and is an equity investor in Osmosis, said, what's fascinating about you, or your firm, not me personally, is you've discarded the traditional fund management approach. You're using a new set of data, it's environmental data, to target and identify alpha, and you solve multiple problems for us. You're not just another momentum, value, or growth manager that's just been through different cycles, consistently underperforming, but promises jam tomorrow. This has got a core thesis that we can see playing out over the long term. So we like that. The alpha is uncorrelated to other, what we call common factors, so those value, growth, momentum, style factors. And the return is acceptable. It's kind of targeting 2% a year above the benchmark. And we might get rid of the students sitting outside the halls. So they gave me my first allocation. The journey from that portfolio was then, well, if Oxford University are behind us, everyone's going to give us money. So I got back on planes, trains, automobiles, went to visit the world's investors, because everyone always wants to talk. No one ever wants to give you money. And they all said the same thing. Great idea, just because they've given you money. Come back in 3 years when this is proved out in a live environment. So again, I was burning nearly £1 million a month for 3 years, operating the business. And we finally landed our first fund, which was a Swedish pension fund, who gave us 250 million. Then the IKEA Foundation gave us 250 million. And the whole premise of that says 10 years later, after launching that strategy, we've been able to prove out that for the vast sum of 20 basis points of a total cost on the fund, which we now run 15.5 billion across a kind of a suite of these low-risk strategies, we've proved out that investing with an environment through an environmental lens can deliver better risk-adjusted returns. So even though we run the lowest risk, sub 70 basis points on that strategy, surprise, surprise, we're in the top third of all performing global equity funds around the world, but we're on average a third of the cost. And we've developed an information ratio of about 0.6 since inception. So better risk-adjusted returns, low cost, liquid, and the environmental impact is those portfolios own 60 to 70% less carbon, less water, and less waste than their respective benchmarks. And that's really all we do. The other thing about the firm is we're singularly focused on integrating environmental data into traditional portfolio theory, portfolio construction. We're not clouded like some of the big firms. I won't mention them by name because I'll probably get litigated, and I'm sitting in a law office and they might represent them. So, and I'm an easy target. But on one hand, they're the ultimate arsonists. So they're sitting there. They sign into committees and regulatory bodies where they get A+ stars with their sustainable teams, running vast amounts of money, hundreds of billions, some of them, while their corporate finance and investment bankers are fueling and providing debt financing for fossil fuel pipelines around the world. So, the firefighters on one side, the arsonists on the other. What a wonderful business plan. And so they're never going to change. So all we want to do is this, keep proving this out, keep taking money away from these, the oligopoly You know, these trillion-dollar asset managers who are all retrenching now because they're nervous about what red states in North America might be saying post the Trump election. We're front foot. It's a depoliticized investment strategy, buy efficiency. You know, I'm not selling this to you today, but by all means go and have a look at the fund. Buy efficiency, because it's pragmatism, it's objective. Just buy companies that consume less to create more, and you'll get better risk-adjusted returns, and it's low cost. And that's the simple evolution and philosophy in the elevator pitch that yesterday took me 5 hours in a podcast to explain, and I think I've done it in 2 minutes. So that's me. Yeah, that's me.
Thank you very much. And I think that the kind of the persistency to push through that off the back of the beliefs that you'd get there is.
Yeah, I mean, I still get told no probably 3 or 4 times a day, and you know, I always joke, you know, I was never the most attractive teenager, and I got told no loads of times at discos and parties by girls, so I got lots of training in my younger years, but it's very similar, you know, you have to be persistent, and time will always be the judge and jury. So as long as you've got the capital to survive, and I'm very fortunate I've got long-term institutional shareholders, minority shareholders, I hasten to add, with Oxford and Jeff Skoll's Capricorn Foundation and Nico Sumitomo in Asia, who are very long-term in their thinking and have supported me through this very complex and challenging journey. And we still haven't cracked the nut. We're running $17.5 billion today, and we still haven't cracked this nut. You know, we should be at $100 billion. You know, you look at Terry Smith's Fundsmith Equity Fund, compare it to our performance. He's based offshore, taking $30 million dividends every year. We outperform him every year on an annualized basis by 2%. No environmental impact, lower cost. And you can go through a whole range of funds. From my perspective, as an outsider still in the industry is fundamentally broken. And if we can try and disrupt it and push and scale and grow, I finally got a voice. I sit on panels like this. I get invited to speak to government. I cause a confusion and nonsense wherever I go, because I've got no shame, but I've also got nothing to lose because I own the company. So you know, I can keep pushing and trying to scale, and that helps, I think.
Thanks, Ben.
Thank you.
And so, Jen, and we talked about this a bit a few weeks ago. Your role's evolved at EQT to having kind of the lens around product development, and you know, spending I think a reasonable amount of time with people maybe from more traditional asset classes, etc., helping them think through them being able to evolve into impact strategies. So, it'd be really interesting to get your perspective on any particular examples of strategies that have evolved and kind of the journey they've been on to then be launched as impacts.
Yep. Well, I mentioned that we launched our first flagship impact fund a couple of years ago. And as you and I discussed, that fund, which is now a couple of years sort of investing, we've got 5 companies in the portfolio already, is performing incredibly well. So there was also kind of a realization that, yes, there actually is alpha here, even when we're screening for positive impact, even when we're putting on the extra work to do the impact management and measurement that we just saw from the CFA certification. Even when we are potentially even screening out opportunities in the strategy, we're performing incredibly well. So it started to generate quite a lot of interest internally around the new strategies that we're designing and whether they should be impact strategies. And it also helps that institutional investors, and I'm interested to hear that you've got a lot of Scandinavian institutional investors in your investment portfolio. They are very interested now in setting aside allocations for impact investing, largely because, let's say, the pension funds have their own stakeholders that they're responsive to who are demanding impact or demanding to know where their capital is going that's serving the planet and its people. And in addition, we're seeing a lot of movement from high net worth individuals who are waking up to impact investing and thinking about their own portfolios, to family offices who may have been invested in a whole bunch of different types of portfolios, who are realizing that, in fact, even if they make their entire portfolio 100% impact focused, they can deliver the returns that they're expecting, and they can receive the benefits that they can also share with their family members and with other stakeholders. So we're finding that there's a systemic sea change that's happening. And I would say it is a sea change when you're talking about 250 billion, which is the size of EQT, and we're not alone, right? We're seeing all of the other mainstream asset managers moving into this space. And so now the question for all of us is, how are we going to be targeting the capital that we have with the tools that we have in the right places and with the right emphasis. So you mentioned that we've been in EQT looking at designing new strategies, and that's true. We've got several dedicated impact strategies now. New one that's a thematic focused strategy in healthcare, the growth sector, mid-market. And we're also now looking at how we can, and this is a sort of pet project of mine, how we can begin to bring an impact lens across all of our investments. And the way that we're doing that, and the tool that we're using, is looking at the level of products and services and revenue streams in every business as we're assessing the business. So a company may be, a large company may have multiple types of business segments and different products and services, and only one of them may deliver a sustainability solution, and we might not capture that now. As we're starting to apply the sustainable revenues lens to our investment sourcing and also through our due diligence process, we can then identify where we can grow those sustainable products and services, either through M&A or sort of our typical kind of buy and build strategy to grow the businesses that can deliver the products and services, even if it's not the entirety of the business, which is typically what you think of when you're thinking of an impact strategy. You're thinking of identifying companies that are in their totality delivering an impact solution or a sustainability solution. This allows us to look at a whole range of businesses across all of the sectors we invest in to identify where we as an investor can begin to apply our acumen to look at where the investment opportunity is, where the demand is, where the commercial growth opportunity is, but prioritize those areas that have that sustainability thematic alignment.
One of the other things you mentioned when we were talking last week was around kind of the conversations you're having with kind of exit valuation advisors around how they think about impact as a multiplier and trying to price that into their valuation models.
Yep.
Do you mind just talking a bit more about that?
This is key. I mean, this is the key, I think, to the success of impact investing overall, is that you invest in and realize that the types of companies that are delivering the sustainability solutions that deliver the positive impact outcomes are the companies that the market values. And we've held a couple of roundtables with about 8 or 9 large investment banks and transaction advisors to try to pull out from them anecdotally what they're seeing in the market. And they're estimating, and I'm just going to kind of give a rough ballpark, that it's around a 3 to 5% upside for companies that can demonstrate in the equity story of the business what their products and services are delivering in terms of positive outcomes. And there's a range of reasons for that right now. There's some sense that this is temporal to some extent because of that systemic capital markets dynamic that's happening right now. We have allocations of capital from LPs to GPs that are hunting impact. So we have seen some big transactions in the last year where impact funds have been vying for the deal, and that's increased the value. That may be temporal, but what we're trying to unpick is the structural underlying trends that I think really underpin the mega trend of sustainability solutions. So then the investments that you're making in companies that can demonstrate that they're decarbonized and they're resource efficient and they're doing great things for people and planet, those companies need companies' inputs from other businesses to be able to do that, to be able to not only actually do the work to decarbonize, but then to be able to give you the data. So there's a whole range of business opportunities out there that bigger companies are demanding. And what we're looking at now is how can we, as we're going through our exit processes, bring that much more clearly into the equity story and into the way that we think about the landscape of the onward potential investors in the business.
Thank you. Peter, I was keen to understand a bit more, and it was really, really interesting for you to talk through the kind of the genesis of the kind of impact allocation you have, but I'd be interested to understand a bit more about how you think about different sectors, the kind of asset class mix that you have, particularly when you're not constrained by having previously said you were going to do a certain strategy. So, how's that kind of played out over the 10 years and different types of investments that you've made?
Yeah, I mean, okay, so, God, these people sound so intelligent compared to me, because I see life so much simpler. Sorry. So we're trying to solve the environment problem. And in order to solve it from an impactful way, every investment we make has to be positive. And so we split it up into sectors of where can you solve the environmental problem the quickest, which is, to us, looking at sectors of electricity, building, manufacturing, and agriculture. And those really, that's our book, if you want. And I should say our book is split into private debt and private equity, because private debt is actually a key side. I'll come on to that. But that's how we, if you want, allocate. But like I said, we're looking for real businesses. So we don't have any constraint that we couldn't be 100% into electricity at one stage in our book. What we want is good businesses. What we want to prove is an impactful business or an impactful portfolio can compete with the largest private equity funds. So I think, you know, I was trying to get some data, but our annualized return is 38%. So we've done that over 10 years. I think that puts us up there. You know, I was trying to talk to other guys in the industry, and they were quite coy, which I guess means we are up there, including Peter Thiel, by the way. So what we've done is we've proven, and this was what we always wanted to prove, that you can make great money out of this area, because impact is a revolution. It starts from the consumer. It starts from the generations that are growing up. When they go out and shop, maybe it's a bottle of water, you know, it's glass now, it's good. They care. They care what they're buying. And this is feeding through to all elements. Then there's the complexity of, let's say, an area like electricity, where also these young people, they love their phones, they love AI. Now, unfortunately, with AI, as an example, you're going to have a computer on 24 hours a day, which is fine if you're in a sunny place during the day. You could run it with solar, maybe some wind, but we have to find a way, let's say, to try and get as renewable as possible. So storage is key. And these are the kind of things we look at, and that's how we invest. And then, like I said, once you're in that thing, you then have to find a company that has a great entrepreneur, a great business plan, great execution. Because there's one thing wanting to be impactful, there's another thing actually executing a business. And what I found is, certainly I would say, around 2010 to 2015, there was many good-hearted entrepreneurs who were coming out in the private equity space, who were starting business, and they wanted to do an impactful environmental business. The problem is they had no business nows. So that was a problem. But as we've seen, as it's become more of a popular area, we've seen more businessmen get in and try and be entrepreneurs. And to me, it doesn't matter. If they're getting in to make money, I don't mind, as long as they are impactful. So as long as they can prove that they do good for the environment or good socially, then that's all that matters. So I think actually, as your business is growing, it makes more sense, because I think what we've seen is there is an expansion of better quality companies. And this is what this area needed. Like I said, when we first started off, we just understood, get the returns and the money will follow it. Unfortunately, it doesn't follow it as a charitable gift.
Thank you.
I was going to talk about private debt.
Oh, yeah.
Private debt we use a lot. I mean, there's craziness that goes on in the world. So if we go back to the credit crisis as an example. So credit crisis happens, and the regulators, financial regulators, stop banks lending to commodity companies. Now, the problem with that was there's a lot of recycling or scrap metal companies, and you can call them what you want, who suddenly didn't have any financing. So we saw a great opportunity to step in and provide that. Now, people don't understand. Recycling metal is an incredibly good thing for the environment. Aluminium, if you recycle 1 ton of aluminium, it's equivalent to 9 metric tons of CO2. If I get this right off my head, copper is 3.5 times, so 1 ton equals 3.5 metric tons. and steel is 1.5 tons. I mean, this is incredible CO2 savings. And there's a whole massive social element as well of not the mining in countries where maybe the mining practices aren't that great. But again, the financial regulators never looked at that during the credit crisis. They just said, okay, you know, it's going to, okay, bank, you want to lend to that commodity company. It was $1 million down, now it's $1.5 million down for your loan. So they all pulled out of the area. So these are the kind of things that still exist today. There's still great opportunities to lend to companies, invest in companies that have real impact.
I think one of the other things that you said when we spoke that resonated with me was the fact that you have the private debt, which means that you can be much more selective on the private equity side, and actually kind of it's what you say no to that's almost more of a driver of the track record than what you invest in on the equity side, because you're not under the gun to either deploy capital or only focused on, you know, looking for equity opportunities. That's right.
It gives us tremendous flexibility to, I call cherry pick. And because we're, okay, actually we've grown. Because I was actually quite shocked how much, it's weird, right? I don't value the fund every month because we're the only investors. We just occasionally look at the same and go, oh, really? So I think we started the fund in 2010 with 16 million. Today it's about 400 and something. So I don't know where I was going with that one. Anyway,
it was debt versus equity.
So the debt side is a lot actually useful to enable to get that kind of return, because what it does is buy us, and this was Charlie Munger, thankfully, and this is Berkshire Hathaway. So what we're doing isn't rocket science. You can Google how does Berkshire Hathaway make money. It makes money from income generation as well as capital appreciation. But the income generation part allows us to be really choosy in the equity part. We're never forced to feel we have to be invested in, you know, X amount in equity. The income generation just gives us a great return. And again, very similar to the kind of Berkshire Hathaway, apart from some charitable donations we do on the social side, we try not to take out big dividends out of this. We have a completely other book, if you want, where we actually take our income from. But this one, in Impact, we're still trying to build it and build it. I don't know if we're going to, you know, as you get larger, returns get harder, there's no doubt. So, you know, I'd like to think we can keep the 38% annualized return, but, you know, let's see.
We're conscious we're kind of getting towards the end, so I might have to just kind of ask you to answer the next one quite succinctly, but I'm sure we've got some people in the audience that are considering or aspirational about launching an impact strategy at some point. What advice would you give them, maybe in 30 seconds from your experience, to help set them on the right path, or maybe avoid the wrong path?
Don't. No, don't unless you've got scale, or some scale to start, because the costs, the stress are just too much now. It's very competitive. I'm a little bit, I guess I have a slightly different thought process and real lived experience about what's happening within the asset allocation at the moment from institutional investors. You know, I've probably met over 200-300 this year around the world, from Japan to Australia to the US. There's a retrenchment going on. So the access to capital is getting harder. It's more competitive. There's margin compression. You know, the private equity space, there's a lot of talk about volatility laundering. You know, they're not really marking their books. And the green finance and the listed equity side, you know, share prices and companies like Orsted and Vestas, just go and look at them. They've crashed. So the exit market for a lot of the private equity side is also drying up, which is also quite shocking because markets are also at record highs. So there's kind of this strange dichotomy going on at the moment in the markets. But if you're really passionate and you really believe in what you do, and because I had no contacts, I had no finance training, and 17 years later, I've done it. But you know, for 10 years, I was in the wilderness. I sold every single asset I had. Literally everything. I had bailiffs calling at the door from time to time because I couldn't afford to pay mortgages, just recapitalizing the company the whole time. So It can be a very isolating, challenging, and difficult journey. So unless you've got access to that investor or investors who are willing to support you for the long term, embed yourself under someone else first in order that you can build that network, get that access, build the trust, because that's what I would do if I went back 20 years, you know. I'd make sure I had the network and a little bit of knowledge rather than just having this ridiculous self-belief that if I just kept going, I'd manage to crack the nut. But yeah, it's really hard. So belief and passion go so far, but contacts, experience are the really things that any time and working maybe for someone else will give you that.
And hopefully, obviously, you know, the more Lynn events you come to, the wider your network will be.
Yeah, absolutely. And there's $400 million sitting here, by the way. So, you know, grab him before he runs off.
Yeah, sure. My partner's going to kill me for saying that.
Jen, I mean, I guess you give advice on a regular basis to people at EQT that are thinking about and want to launch impact strategies. But what about from a more independent perspective?
Yeah, so one of my side hustles is I'm a founding member of an organization called 2X Global, which is the kind of one-stop shop for gender lens investing. And we've got about 150 members. And one of the things that we've been doing is working on an accelerator for first-time fund managers. So I know the pain of setting up a first-time fund and the scale problem. And I would absolutely echo that having a core anchor investor from the very beginning of your thought process is a really important and key aspect. And then also having the network and looking to accelerators where you can get the skills that you need. So that's on the sort of smaller scale. But personally, what I'm doing with my career and what I believe is the future in terms of the way that this whole industry is moving is the power of the institutions and the systems that exist. So moving into a mainstream fund manager or a mainstream institutional investor and being an entrepreneur to help to design the strategies that can move capital in the directions that the planet and our societies need, I think is a very strong way to go. And you can avoid some of the pitfalls of having to be all on your own out in the wind.
Peter, any advice that you would pass on?
Yeah, absolutely get into the area. It's a fascinating area, and I do believe, like I say, it's a revolution. Don't get into the voluntary carbon credit market. That is not environmental. It's actually a con of a market. Maybe it will sort itself out.
We do have an event in January that's focused on carbon markets. So,
I would love to be on that panel, trust me.
The title of the event is "How Can You Deliver Impact in Carbon Markets?" So I'll send you the.
Oh no!
synopsis.
I mean, please. I can even tell you I'd like to sit next to it and have a chat with. But it's such a great area. This. I mean, intellectually, right? We've got to solve the biggest problem ever we've created as mankind. And that's not just environmental, that's also the social side. So, you know, I think it's a fantastic area and you should definitely go for it. I don't know which route to go down, but it's definitely an area to be in.
And final question, and I'll kind of push you to not one-word answers, but one-sentence answers. If you had a magic wand and you could do anything to try and, you know, instigate some type of change that would help to scale impact investing, what would you do?
I'd want to be 20 years younger and look like Brad Pitt.
Is that good for impact investing?
It could be. It could be. I'd get more of a profile, but no. I think if I could really, you know, the biggest change we need is unfortunately, and I don't want to sound patronising, but unfortunately, a lot of the resistance comes from people with poor education. So if we could raise the general education levels of people to understand that this problem is real and it does need addressing, and if we don't do anything about it now, and I do refer to our North American friends very much around this, which is that you can ignore the problem, but it's not going to go away. And poor education has led to what I would consider a very poor outcome for society and for the planet. And that compounding effect of carbon in the atmosphere, we've done some analysis on this. And this isn't a 1-second answer, I'm sorry. It is going to be a real challenge for society as a whole. So, you know, magic wands we don't have. So again, it's down to people like you and people like us to keep hammering away at the message to articulate and try and get the change that we need. So everyone just to say yes. How about that?
Yeah. Or everyone to try and turn around and use their influence on the next person and pay it forward, maybe.
Yeah.
Jen, what would you use your magic wand for?
Well, I would wave my wand and hope that the markets really do begin valuing impact and that all investors are investing for risk, return, and impact.
And Peter?
I kind of said it already. I'd get rid of the voluntary carbon credit market. I think it's done so much, it's created so much negative press around this area, and people aren't educated, don't understand where it fits in, which isn't a big place. I'd also like, can I have lots of wands?
Give you two.
Okay. I'd also like to see the governments around the world focus on looking after nature. Don't worry about anything else. Private markets will do that, but I think the nature we have in this world needs to be protected, and the only people who should be custodians of that are the governments.
Excellent. Well, on that note, we'll wrap up, and thank you all for taking the time and sharing your views. Is it all right to run over 5 minutes for questions? Yes? Excellent. Any questions for the panel? We'll just go one there and then over there. Have we got microphones? We'll go here first and then over there, kind of halfway down, third person in.
It's me first, is it? Yeah.
Yes.
Alice Gaskell. I'm a fellow of Tribe Impact Capital. I just wanted to ask Jen, because no one here is finding good opportunities to invest in social impact, whether you have found strategies or assets that work from a social impact perspective.
So a lot of what EQT invests in is healthcare, and we really focus on ensuring that we're investing in companies where we can actually trace the ultimate outcomes, the ultimate impact. But I'm very excited, and this maybe is a little bit related to my side hustle of gender lens investing, in the prospects of investing in the care economy. And we have quite a number of assets that are really strongly performing, particularly in some transitioning and emerging markets that are entirely focused on providing care economy support, childcare, elder care, et cetera. And I think from a social aspect point of view, both from an equality point of view, as well as from kind of a gap in the market and an opportunity point of view, it's a very exciting space.
Yep, over there.
Yeah, Sujay. Hi, thank you so much for the session. It was really insightful. So I work in the EY's sustainable finance consulting team, but a lot of my background was in adaptation and resilience building with the UN in Asia Pacific countries. So when I'm trying to kind of bridge the gap with like impact investing in the sustainable finance space, one of the biggest challenges I'm seeing is like, how do you make an investment case for adaptation and resilience building, and especially kind of like tying in the nature aspects as well? So we'd be curious to know, like, are you already kind of doing it in some ways, or like how are you exploring it?
Anyone want to pick up resilience and adaptation as an investment theme, which I think is the question?
Yeah, we've actually, so the portfolios kind of mitigate environmental risk, I guess, from a financial perspective that we run, but we've actually put through we wanted to look at biodiversity, impact on nature, listed companies, and there's lots of funds obviously launched because it's a trend and it's a theme and the big firms get hold of it and say, we'll just shoot out another fund, capture some assets, and then the bad performance hits and no one cares, and off we go again. So rather than doing that, we said to one of our guys, go off and do a PhD, we'll fund it, and we sent him to Oxford, and he's just coming to the end of that now. And I bumped into him in the office the other day, because this is all about resilience, yes? And I said, how are we going? He said, well, I've identified all the problems. And I said, well, bloody great. So, we spent a lot of money and we've lost you for 2 years. What's the solution? And he said, I haven't got it yet. So the honest answer is, from the data we use in the public listed space, it's really hard to do, certainly in the large cap space where we kind of operate. Smaller cap, yes, I think there's work you can do there. But if you take the chisel too far, you start refining your investment universe to such a small degree that it becomes uninvestable from a large pension fund perspective. And our mission is to transfer capital in scale and size. So until we find solutions that really work and that you can scale, we kind of back away and let other people kind of play around in the area, learn from their mistakes, and then try to be a little bit smarter about how we bring it to the market. But it's the right question. We just don't have, honestly, the answer yet at Osmosis.
There's a lady called Nicola Ranger, who I think is also at Oxford, who's done some really interesting work around resilience and adaptation. There's a policy and an investment theme. It's probably worth looking up.
Yeah.
One more question, if anybody? We're just down at the front here.
Thank you very much. Raheem Hussain from Reddington. They say that maybe 40% of the world's technologies needed to achieve net zero haven't been created yet. So how much of the opportunities do you think sit on the lower end of the scale with sort of companies that are just starting out rather than the large cap space?
Peter?
I think it's all going to come from the private market, sorry. I mean, that's always where you see disruption come from, advancement come from. It's nothing against large companies. The problem is that they buy these companies, by the way. Let's hope the right company buys them and doesn't, like the oil companies tended to do. They bought some, they call it environmental technology, and just put it away in the cupboard for a while. But it has to come from private companies, because in order to solve some of the challenges we have, you have to have, if you want, creative thinking outside of the box type. And this only comes from when you get a small group of very intelligent people working together. It doesn't tend to come from a big organization. You can even see it, actually. Some of the best investors in the world are investing in smaller type companies. If you're interested, have a look at, it's actually a quoted company. It's called Oklo. And I think...
Sorry, how do you spell that?
OKLO. It's doing nuclear fission. And you have to see who's on its investor base, its shareholder base. It's fascinating, but it's almost all the tech giants there, you know, Zuckerberg, Till. You can go down. It's,
So I've got to jump in and disagree.
yeah, go on.
I do agree. Innovation often comes from the private markets, but you know, R&D spend at the largest companies in the world is, apart from with the backing of our good friends in private equity here, who obviously help facilitate the private markets, but the listed markets R&D is huge now in this space, because this isn't for them about solving the environmental crisis.
Existential.
It's economics. It's basic 101 economics. If you can reduce your cost base, you make greater profits, and that benefits shareholders, of which obviously management are often participations in. So it's, we see, and actually under EU regulation now, there's a green capex rule coming out, and there's some studies being done which you can see the amount of green capex being spent by listed companies, which you then can model through and see whether or not that will trend into greater return on equity. And you know, if you don't believe me, then look, I think Goldman's did a study on it recently. I think JP Morgan have done a study. The unfortunate thing is obviously it's quite bifurcated. There's not enough of the data yet, I think, to hang your hat on it and make relative comparative observations, but there's enough of it. And that's what we need more governments to be behind from a regulatory perspective, rather than spending all this time and money with lawyers on the name of your fund. Regulate the system so the quality, the quantum and the quality of the data is actually meaningful for investors to use. And I'm going back to wishing my wand again, but yeah. So yes, private markets, but the amount of money being spent in the listed public equity space is vast, absolutely vast.
And actually, some of the investors that I speak to that are sat in CVC teams have actually been able to have a lot more bandwidth to get involved in some really innovative sectors, because they're not beholden to a rate of return in the fund, and it's more aligned to actually how to support a business model. If it's a clothing company, etc. There's looking at different parts of the circular economy. It's not because they need a return; it's because they need a solution. It enables them to have a bit more bandwidth to get into that more innovative space.
But you'll make 38% a year over there
Yeah.
and you'll make 8 to 10% a year with me. So
Well,
pick your horse, pick your rider.
No, we don't take outside money, right? Just to be clear.
Not yet.
No, never. I've done that once, never again.
Well,
I
on
would
that-
say this
go
though, on this point, big companies are good things, right? I mean, and take where we are today as far as technology. Rank Xerox was key to where we were today, but they weren't the people that actually created the products. Yes, they had the computer that Jobs used to climb over the wall and Gates used to climb over the wall and use. So their R&D department was key, and I do think they will spawn the next group because they are putting money in R&D, but I'm pretty sure it'll be a private company.
Let's say we'll both.
Just have a
win.
look. Just have a look at the Dow Jones, for instance, and the change of the components.
Oh,
over
absolutely.
the years.
Yeah.
It tells you everything.
Well, and it's also a shrinking public equity universe. Then lots of companies don't want to list because it comes with more regulatory burdens and
That's
more
true.
transparency, God forbid, which you don't also often get in the private markets to such an extent anyway. So, it is always horses for courses, but we need both.
Yeah, definitely.
And because the banks, again, I have a bit of a thing about the banks, won't finance a lot of things,
that's what people
which
say,
is
yeah.
where the private equity market saw a huge opportunity post the credit crisis to step in and, doing their debt funding and like you've been doing. It's filled an important void and with some expertise behind it as well, rather than just looking at the balance sheet, seeing the opportunity more in the round. And that's filled a really critical hole that was missing. And now what, of course, you're seeing is the banks starting to buy slices of private equities and tie up with them so they can do these joint ventures and get back into it again. So double dipping on fees to obviously, hurt the unit holder even more and not get the return they should be getting. But that's another story as well.
Another story.
And obviously nothing that you guys are involved in, but there's been some press releases recently about big private equity and indeed big hedge funds re-tying back up with banks and big distribution channels to try and monetize it, not for the benefit of society, not for the benefit of the planet, but for the benefit of their bonuses at Christmas time. So, but that's it's capitalism, and I am an eco-capitalist, so I'm not always against it. I just think it should be done in the right way.
With maybe more transparency.
Yeah.
We'll get there one day. Well, thank you all very much. And I think we're going to have probably 15 minutes of networking break, and then we'll come back for the next panel.
Thank you.
Right, it's time to talk social impact, a topic, as you probably already picked up on, close to my heart and not often enough talked about, as already highlighted by one of the panelists previously. Most attention does go to environmental strategies, unfortunately, for good reason. The needs, however, are at least as high when it comes to societal challenges, and the potential and investability not necessarily less. The spectrum, however, is vast, so let's dive right in. We did get challenged by the previous panel that the best way of doing social is by giving away money. It's not something I necessarily agree with, so let's see how we go as we go with this panel, because I'm sure there are different views to be shared here. Right, really delighted to be joined by this brilliant set of panelists, Anna Scheel, Chris Webber, and Tara Gillespie. I'll start off with just some fundamentals. Let's get to know our panelists a little better. So why don't we get a bit of perspective on their personal journey in a way. So how are you currently involved in social impact, and how did you end up being there? Anna, why don't we start with you?
Okay, I'll start us off. So I'm currently Chief Investment Officer at Better Society Capital. So we are an impact investor, and our mission as an organisation is to really grow the impact investing market in the UK. So that's to crowd in the amounts of capital that are tackling social challenges in the UK. And I've been doing that now for 12 years. In fact, LinkedIn told me today that it was my 12-year anniversary, which is incorrect because it was last week, but anyway. So I've been doing that for 12 years. Before that, I worked in mainstream finance. So I was an investment banker. I worked advising asset managers, banks, insurers in the UK on M&A and corporate finance. And I had an enjoyable and rewarding decade or so of doing that, but I did feel there was something missing, and I started to slightly question what the purpose of finance was. And I was kind of seeing it at multiple levels because I advised financial institutions, and I sat in a financial institution and worked in one and saw some of the different elements of it. And it was interesting, it was fast-paced, there were some great businesses, but what was it all for? And really I started trying to explore that question. I spent some time looking at microfinance internationally, but I wanted to apply some of the kind of skills and uses of finance to the problems that we have here in the UK. And very fortunately for me, a new organisation called Big Society Capital at the time was being set up to grow this market. So I joined when we were about 6 months in, and I've been there ever since, and I've sort of seen the growth of the UK investment market close at hand.
Thank you. Very convincing. So I'd say I don't work in social impact investing, probably fair to say. So I work for a company called Reddington, and we advise institutional investors on all aspects of investing. Reddington has been built on a mission, though, and that mission was to help make 100 million people financially secure for the benefit of people and planet. It's a mouthful, but it means a lot to us. And as a result, we've attracted a lot of mission-driven investors and working with them to help them invest in line with their values and their mission. And as a result, social impact investing has become a big part of what we do and how we support those investors. So it's happened through it being an important part of our mission, but also what our clients are looking to achieve with their investment strategies.
Great. And I'm Chris Waby. I'm CEO of Lendable. Very pleased to be here. In terms of what we do, we are a provider of debt or private debt to predominantly fintechs across emerging markets with the goal of financial inclusion, so trying to bring access to finance to people that might not otherwise have that. We also have launched a decarbonisation strategy, so that with a slightly different impact thematic, but the same sort of investment product. In terms of how I came to this space, somewhat I felt like my story was already told in the previous panel with Peter. I started my career in completely traditional finance. I was at Lehman Brothers as a trader and then started a hedge fund. We grew that hedge fund from a startup business to about $7 billion in assets, which I thought was quite a lot, but hearing EQT sounds quite small. And had a chance to monetize my stake in that business and felt like I wanted to do something with a little more purpose, or that I could have some sort of more impact. And so with that sort of intent, but also a lot of chance, I ended up involved with Lendable. I first tried to do a PhD in economics, found it very, very slow, and probably harder than I thought it would be. And then started investing some of my money in both traditional assets, but also in impact. And first came across Lendable as really a concept. It wasn't really a business at the time. It was a couple of cousins, who are still my partners now, who had created a technology where they could integrate with loan management systems and track basically flows of receivables in emerging markets, something that you find secured lenders being able to do in developed markets, but not really in emerging. But they didn't really know how to monetize that. And so I ended up funding their first transactions, becoming non-executive chair of the business, and somehow informally working 5 days a week, even though I didn't have a contract. So that's how.
Wow, what a journey. Brilliant. Before we start talking, because clearly performance is a key topic this evening, before we go into that, I'd like to just touch on the kind of fundamental, or even like you could call philosophical side of social. And I think there's no one better to speak to that than yourself. Do you believe social factors are a driver of value?
Probably unsurprisingly, yes. So where does that start from? I mean, essentially starting from the premise and our belief that, there are business solutions to social problems. And there are huge problems out there that need that because we simply don't have enough capital from government or even philanthropy to be able to tackle those challenges. Look alone at the housing crisis just in the UK and the need for affordable housing. I mean, if you get to really scary numbers, you're talking about $500 billion, but even to look at the affordable housing needs, 10 to 20 billion a year that is going to be needed in order to meet that. That's just one example of what we'll need. So we need that capital, but fundamentally there of course have to be business solutions to those problems. And what we've really looked for is to find that intersection between where is there that capital need behind a social problem and where is the business solution to that. And it's by finding those, and that's been in areas like social and affordable housing. It's been looking at SME lending into underserved parts of the UK. It's looking at technology solutions to entrenched problems around financial inclusion and mental health, that we've actually been able to then contribute and work with others to fuel the growth of an impact investing market in the UK from a 12-fold to about 10 billion. So I think that just demonstrates that there are those solutions, there is that investor appetite, and that can be a fundamental driver of those market opportunities. There are other perhaps levers around how social can drive value in those business models that we can perhaps come on to further on in the discussion. But clearly, the starting point is it actually helps you to identify investable opportunities by taking that social lens first, which may have been overlooked by others who don't take that lens to their investments.
Well, let's test that statement and that view by talking actual performance based on some real examples. Chris, to start with, on your side, I think it'd be really interesting to get a better sense of, like, how commercially viable really is social investment, and is it actually generating competitive returns? Can you give us some insight into your various funds and their performance, where possible, with some perspective on comparable funds or asset classes? And if you could give an indication of what the strategy is like, that would really help the audience put it in perspective.
Great, yeah. And actually, this is really explains why I ended up sort of falling into Lendable and spending so much time on it. If we think back sort of 6-7 years ago, our track record is actually about 8 years now. Financial markets in traditional sense, I think, were showing incredibly low levels of value. You had interest rates kind of at near zero. I come from an arbitrage background, and everything I looked at, basically there was very, very little value that I could find in traditional investments. And coming across Lendable, that was sort of lending money, assets, so we do asset finance, MSME finance, some consumer finance, basically senior secured lending against, over-collateralized against receivables. I was looking at transactions where, from an impact perspective, they had a clear value add, but we could make mid-teens returns with really sensible risk in hard currency, hedged, with everything really sensibly done. So actually, I think my fundamental interest in doing what we do came from the fact that it was very commercial in terms of return. I think it was made on the last panel in terms of the importance of that. When something's not commercially viable, it will always stay niche. Until values are fully aligned in terms of both financial and other, I don't think you'll ever really get scale. So in terms of our track record now, we have 8 years of track record. I think net IRR after fees is about 13.3% over that period on an annualized basis. And so I think that is, I don't know what percentile or decile it would be, but I think it's top tier and comparable with anything commercial, purely commercial.
Wow, it sounds very convincing to me, at least. But I think probably worth, because I appreciate this is in the end fairly niche. Not everyone can invest in this asset class. Perhaps looking slightly bigger picture, would be interesting to hear, Anna, your views through your various funds and co-investments that you have been doing and facilitating. Whether that resonates or whether you are seeing a different picture.
Sure. And I guess the perspective I'm bringing is a combination of, from things that we've invested in. So we've committed about 950 million across a range of different strategies into intermediated funds and other models. But also the kind of vantage point we have as a market builder in seeing the kind of wider market that's evolving. So it's a bit of a sort of perspective from both of those. And I think the first thing that's really important to bring out is that impact investing isn't a single market. There is a set of underlying asset classes and business models that have different profiles in terms of what their expected risk and return is and how that relates to impact and how those perform. So I think it's really important to sort of note those differentiators. And that actually means that you can align what investors are looking for with what those underlying business models can generate. So we see a real range, which is, there's impact venture capital strategies, which are typically targeting under contract to deliver the kind of returns you'd expect, from any other VC strategy. We seek to find those that are going to deliver top quartile performance. That's driven by the belief, and I think the evidence that this impact can be a source of value. So that actually the best founders, which is such a key driver of success in venture capital, they want to solve big problems. And actually, if you want to attract that talent, that's an absolutely key magnet to some of the best people. But actually, there can also be other levers of that value, whether that's actually retaining talent through the organization, customer acquisition, and other drivers of that value. So those are very much looking to be competitive with typical market returns. There are other segments, like I've touched on, social and affordable housing. Again, the fundamental belief there is that that can provide a long-term inflation-linked income to those investors like pension funds, for whom that is what they're looking for within their portfolio to support their long-term liabilities and pay out their pensioners. And again, if you look at something like affordable housing, there's a key underlying structural demand behind that, which underpins some of the risk there. There's also actually a government-backed revenue stream, which makes that an attractive asset. So again, you're getting that alignment. There are other parts of the market where I think the nature of the business models and the way they create impact potentially have slightly different trade-offs in terms of the way that they, they may be compromising some element of their returns in order to provide the impact, perhaps by employing people who are further from the labour market in their models. But what we're seeing there is that actually sometimes by bringing together public and private capital, you can de-risk some of those investments using guarantees, for example. So it's still providing for the right investors an attractive risk-adjusted return that might be long-term and aligned to what they're looking for, as well as really compelling impact. And at the same time, it's actually allowing government and other sort of philanthropic sources to lever their money and make it go further. So I think that sort of message that it's not one market, but I think ultimately we are seeing how that impact can drive the value.
Tara, really keen to hear your views. Unless you'd like to add to the performance side of things, appreciate you do look at a wider universe through Reddington's manager research team. Happy for you to talk about that a little bit, or we can go to your view and actually hearing what's the appetite of the investor.
Yeah, why don't I cover a bit of both? So I think echoing some of the points, but maybe just adding some numbers to it. We have some clients who will be doing social impact investing with the only intention of having money returned to them, right? They don't have any return expectations, and actually if they get their money back, they think that's a result. So that is one bucket, and it won't be a whole portfolio. It'll be a very small segment of an overall portfolio. But that is real concessionary capital. Most investors, even the ones that want to go and look at social impact, will be looking for market-based returns like you've said, and that will vary depending on asset classes. So sort of social housing type strategies, 6 to 8% we see. That's really comparable to a private rental sector, sort of more core, but same asset class type return profile. So no concessionary capital sort of give up there for that social impact element. Another asset class that we do a lot of work in, or are sort of currently researching really actively, is health. Again, really broad spectrum of how you define social impact within health. But we've seen private debt strategies that are getting between 10 and 15% IRRs, and VC or growth for equity strategies that are north of 25%, rivaling the 38% that we heard earlier. And no investor would turn their nose up at that, but I think it's important to lift the bonnet and have a think about, well, is a med tech fund or business that's selling their tech into a for-profit hospital in the US actually a social impact investment? Perhaps not, and maybe the micro lending for community projects that's not returning anything above the capital that's been given is that kind of catalytic impact. So that's the sort of spectrum, and I think it's probably a long answer to, there isn't a single answer to that point. In terms of the demand, we work with a whole range of different client types, and within the global assets team we support local government pension schemes, endowments, wealth managers and insurance companies, and I can tell you it is absolutely fascinating going to the investment committees of those range of investor types and talking to them about impact and sustainability, because the views are really, really broad. You've got local government pension schemes who have a regulatory pressure on them to invest locally, and that also comes with a sort of impactful angle to it. I'd say UK is the priority, and then impact comes next, but it often comes hand in hand. So that's a real priority for them, and it's being driven by the regulator. Endowments will almost always have an overarching mission, which will often connect to a social cause, whether that's poverty prevention or public health or environmental. And increasingly, we're seeing our clients want to reflect that mission in their investment portfolio to a greater and lesser degree in some cases. But it's definitely a hot topic of conversation amongst trustee boards at the moment. And then there's the wealth management sector. And I don't know if there's any wealth management industry people in the room. I suspect not, because our experience is that there is just very little appetite in that sector to do anything above traditional investing. And one of the things that hypotheses we get given to sort of test is, well, yes, but the next generation are really interested in it, or higher net worth individuals who've made a lot of money and want to do something philanthropic alongside their investment returns, they think about it differently. The evidence would suggest not, or at least not yet, perhaps. I was talking to someone who's the co-founder of a wealth management business that is set up to target next generation wealth and the kids of high net worth individuals, and they said it does not come up at all. They're prepared to talk about it, they've got investment solutions to support, but it doesn't come up. So I think that is a sector that there's still a lot of room, and people like us as advisors could probably do a lot to take them on that journey.
Thank you. You've made a very nice segue there to the investor appetite, which is, of course, a very core part of this evening's discussion. It does vary. It is a very broad spectrum, and you've really laid that out nicely. Anna, can you touch on, you've already mentioned a little bit how the market has grown, but your experience on the actual appetite, and perhaps touching on, for example, the social impact trust, how the inflows have been as a concrete example.
Yeah, absolutely. And I think Tara said actually quite a lot of what I would have said in terms of where the pools of demand are coming from. But I think the first thing I'd say is that it does feel very different to a decade ago in terms of the range of different investors who want to have a conversation about impact. And I think Will said that as well, in terms of the sense this is just coming much more into the conversation. So sometimes we talk about it saying we used to have a lot of why conversations, used to talk to people a lot about why impact. You have a lot more how conversations now, which is how do I do it? What are the opportunities I can find? How do I implement it? What does it look like to really embed impact practice into what I'm doing? How do I report it? So, and I think we see that across the board actually in terms of investors. But yeah, we do a kind of market sizing exercise. So starting in 2011, we looked at what the size of the impact investing market was in the UK, and then we every year check what that looks like. So our last market sizing came up with £10 billion, which is a nice round number. But the first thing we did was dig into the different investor groups within that. And very conveniently, they very much mirror what Tara's just said. So the biggest group has been local government pension schemes, which are accounted for about 20% of the market sizing that we saw there. And that has really been fueled by this local impact requirement that is starting to drive some quite significant allocations. I think initially into housing, into some kind of just transition-led and sort of even some nature-based solutions. So that's starting to really move. The other group is endowments. And I think the really interesting shift there is moving that from being a conversation about a small carve-out or potentially sort of repurposing of certain grants to do something, which some pioneering investors have done here, into a much more holistic conversation about how the endowment as a whole can integrate impact and embedding that. And then we do have the asset managers and the wealth managers and the high net worths, but they're probably the smaller and sort of final group. So we're seeing it across the board, but I would say it's been particularly driven by some factors that I think are driving those first two groups. In terms of the impact trust that you alluded to, so we are predominantly a private markets investor, and we invest essentially our own capital, which comes from dormant bank accounts and the 4 high street banks in the UK. But something that we observed is that those types of kind of illiquid long-term patient investments weren't necessarily accessible to certain investors. And that's really the genesis of the Schroders BSC Social Impact Trust, which is essentially a partnership where we're seeking to make accessible to investors who need that liquidity and diversification, but want to invest into deep impact strategies. So that's what we've seen with the trust. It was launched in 2020 in order to kind of offer that, that access to those deep impact opportunities, investing in high impact housing, debt and equity for social enterprises, and also social outcomes contracts. And so that's been another interesting lens in just seeing that there is that appetite from investors to access those kind of strategies here in the UK.
So the appetite is there, and Chris, it would be really interesting to hear, of course, you have been raising capital for various funds now. What has that experience been like? And also, have you been able to tap into any of these investor segments? What have you been leaning on? And if you don't mind sharing some of the challenges, that's always very insightful.
Sure. So I guess our investor base is pretty split. I'd say it's predominantly non-impact investors, purely commercial investors that will look at us with a commercial lens. And so I guess that comes back to the importance of having attractive returns purely from a risk-reward perspective, and then impact being an outcome that you can also produce on top of that. And as I said, so I think for us, we wouldn't get to where we've been so far, and we wouldn't have maybe got that initial push without that having been core to what we do. In terms of standalone impact, I guess I might have a slightly different answer to what I've heard, and I think maybe one of the two key factors might be geography and scale. I think that on the wealth management side, or sort of the family office type side, there are definitely some pools of capital there that are focused on impact, interested in impact, and want to do it. And I think if you're trying to raise hundreds of millions but not billions, I think there is quite a good market there of investors that have a clear focus, clearly understand impact, and you can raise money from quite successfully. But I think the point would be once you get to a size where we're heading to on a consulting scale, that doesn't scale to billions, it scales to hundreds of millions. I think the other thing is maybe geographically, we see that there's quite a lot of demand and knowledge around impact investing in Europe. So if you look at a lot of microfinance, that's funded predominantly from European retail, whereas UK or US have basically no interest. So I think it also matters where you're looking geographically at those segments. In terms of then how we fund ourselves, I guess there's a segment that we touch that maybe is very just impact specific, which is development finance institutions. We work with pretty much every development finance institution across the world. And obviously they have a specific impact mandate. And so have a direct interest in what you're doing. I would say they come with a different set of challenges. Whilst I think they're interesting in that they don't have the same cyclicality as others and think about risk, and when a certain market goes out of favor, they have consistent demand. They are obviously political institutions which have a lot of administration, a lot of demands that may not focus on the best investment result, and so try and put a lot of restrictions on you, so that there's not a free lunch. And I guess then there's the blending of those together, the commercial and the DFI that you can also do.
Well, really appreciate those tangible examples. And I imagine, Tara, you may have some to add there as well. I appreciate you already introduced kind of the appetite that's there, but would actually be really good to hear what's being allocated. So perhaps you have some specific examples as well of investors taking these initiatives and actually, putting their money where their mouth is.
Yeah, we have a few. One that sort of springs to mind that's pretty interesting, but I wouldn't say is reflective of the average by any stretch of the imagination, is an endowment client who is challenging themselves and us as their investment advisor to think about investing for social impact across the whole portfolio. And so some of the opportunities that we've talked about now are very specific within a asset class segment that would just never represent a whole portfolio. And I think social impact investing does lend itself to the private market in particular, and call it 75% of an investor's portfolio is more likely to be public. So rather than just give away the other 25%, as maybe was mentioned in the previous panel, what can we do with that 75%? And this particular client, their focus is poverty and anti-racism, and those are not themes that you can apply to public market investing particularly easily. And so we're really having to challenge ourselves in the way that we're thinking, rather than just saying, well, allocate to social housing and private debt opportunities, which I'm sure are highly impactful, but that's small size. And so what does that actually look like in practice? Well, it's deciding where to draw your lines, and this particular client has ethical hard lines, and they say they will not invest in some very large public companies that they don't think treat their employees fairly or aren't doing what they should be doing in their local communities where they operate, and so they will exclude them, and that's where their line is drawn. Absolutely fine. And we need to work with fund managers who will do that. But the second lever that they want to use is stewardship and engagement, and to try and use their passion and drive as social-driven investors to influence companies via their fund managers, and hope that their fund managers will be able to use the weight of their capital to be able to influence those companies for positive social impact and change. The third thing is primary funding into those types of companies. And so one thing that is always focused on in impact investing in the public market is equities. So, buying stocks and shares in the companies rather than the bond market, because, well, you don't have a vote if you're a bond holder, so what's the point? And actually, that's where those companies are really going to feel the pain. If the cost of funding goes up because people don't agree with the actions that they're taking within their business, then that stops them doing activity today. It doesn't really affect them if someone sells their share in that company on a secondary market. So really thinking carefully about the bond investments that they're making and ensuring they're not providing primary funding into sectors and companies that are sort of fundamentally not aligned with their social impact views. So I think that's a really great example of a pioneering investor. I'm not saying that that's what all of our clients are doing, but it's really great to see that that's a direction of travel that some of our clients are going on with us.
I think that's an interesting piece to delve into a little further, kind of those barriers. There are those ambitious investors that are really clearly willing to venture out there, but it isn't for everyone, and it would be interesting to hear a little more about those barriers that are being experienced, because it sounds like there are actually interesting options out there. They are generating returns, possibly slightly higher risk. So would be interesting to understand what those considerations are that in the end stop investors from
So I think with everything in life, those who are really motivated won't let the barriers get in the way, and they will just go and do it. And then there's the sort of middle group that are stuck in oh, but this, oh, but that. And some of those buts are justified. So take the first one, that the perception that social impact investing is concessionary capital. You're giving something up in order to do it. I think that is the case in some parts of the market. It's not the case in all, but making sure that we can remove that barrier by showing them where that opportunity, where the investment opportunity stands alongside that social impact opportunity. The second is risk. The pointiest end of the social impact investment spectrum is often the riskiest, and that we have to face that reality, and it's certainly often the most illiquid. And I was probably a bit harsh on the wealth management sector, but mass market retail just doesn't have the ability to access illiquid strategies, in a significant way, and not in the way that the institutional market can. And so that makes it really tricky for them. I'd say the third thing, and you kind of touched on it, Chris, is about scale. And we see funds that look like they're doing incredibly impactful work and are going to promise to generate returns that are really, really attractive, but they're raising £10 million. And £10 million doesn't even touch the sides with many of our clients, and it makes it quite challenging to do the work to justify that allocation in the portfolio when it's going to be such a small part of a £15 billion pension fund portfolio. So that is an unfortunate side effect, and it would be great to see some more innovative ways to overcome that and allow those earlier stages to be funded in other ways, family offices perhaps, and high net worths being an option there, but to make sure that the institutional capital is coming in at points that in the growth cycle that still have a really big impact on those companies' impact stories. But yeah, there's plenty of barriers, and I think those who are motivated will still do it.
Well, removing those barriers and closing that gap between that clear, the appetite is there, but not necessarily the access or the alignment in risk appetite. Would be really interesting to talk a bit more about how that's already being addressed or what can be done, thoughts around actually what innovation is needed to direct that capital towards those societal needs. And are considering Better Society Capital's mandate to crowd in capital to tackle societal challenges. It would be great to hear about your first-hand experience of actually bridging that gap and finding ways to, you already touched on it earlier, but I'm sure you've got more to add to that.
Sure. Yeah, and I think at the moment we're at this interesting point where we've got some great examples and case studies and markets that are being built, but we've also got these immense challenges in front of us. So it really is incumbent on us, but also others around us, to find a way to kind of scale up and overcome some of those. And actually, probably what I'll talk about nicely does dovetail as well as to what Tara was saying about some of those barriers. So the first is this is still a newish and early stage market. I mean, there aren't necessarily the 20, 30-year track records that lots of investors need. And some of these are pioneering and innovative solutions to these social problems that not every investor has got the appetite to take. So I think the key thing is actually we and others do need to invest in some of those innovative strategies that demonstrate what can be possible. And then really importantly, share the learnings from those as widely as possible so that they don't stay as these kind of perfect miniatures that a small group of us know about, that we actually share them more widely and allow those to be scaled up and replicated. So an example of something that actually a really pioneering foundation helped us create 2016 is something called the Fair by Design Fund. So Joseph Rowntree, experts in poverty, they really, they sort of shared some of their insights about the fact that people in poverty pay much more for basic goods and services. And there was a sort of moment of saying, well, that's both horrendous, but it's also suggests that there is potentially a business solution. So that led to the creation of a venture fund that was specifically tackling that. So looking to find businesses that are bringing down the cost of financial services, energy, food, basic goods and services for people that live in poverty. It's invested in businesses like WageStream, which you may have come across, which is a salary finance model, so allowing employees on lower incomes to draw down their salary rather than waiting for the paycheck every month, so that they then end up taking on high-cost credit. Instead, they can access and smooth their income. So innovative solutions like that. They've now gone on, not only have some of those ventures gone on to scale, raise money, some of them have exited, to major sort of trade buyers, others have gone on to raise more sort of down the line. But they've also raised the second fund, so demonstrating that actually you can continue to build those strategies. So I think that just shows the power of those demonstration cases of how there are these kind of business solutions to those social problems, which might be pioneering. I think the second one is about scale and some of those other barriers. We do need to create the right product structures for some investors, because we can tell people all the great examples all they like, but if it's not going to line up to what they need in terms of scale, in terms of liquidity, in terms of diversification, then they're not going to come in. That's sort of a hard problem to crack, but it's one that financial markets have been doing forever. So bringing the right people together with the right will to create those products, I think, is eminently doable. The Trust is one example of them, but there are lots of others out there that are trying to do that. I think the third piece is around accepting where there are sometimes those solutions that are sustainable, they are enterprising solutions, but they perhaps don't quite align with the risk and return requirements of investors without something else coming into the mix. I think there is an opportunity to bring together public money or other philanthropic money together with that private capital in order to bridge some of those gaps between the kind of risk and return and the impact that is there. So we talk about that as being blended finance. That might be terminology that's very familiar to people. It might not, but it's essentially bringing concessional capital together with non-concessional capital to create much greater impact. We've invested about 270 million, it's probably a little bit more than that now, into those kind of strategies using first loss structures, guarantees, tax reliefs, in order to kind of make those different requirements add up. And I'm just going to give an example that I think quite neatly kind of brings together different elements of this. So there is a huge finance gap for SMEs, particularly in more deprived parts of the UK. So banks have tended to pull back from those areas, and there can be a perception that the markets are very weak, and therefore business owners, entrepreneurs really struggle to access finance there. 20 or 30 years ago, a group of kind of alternative lenders emerged. They're called community development finance institutions, quite a familiar model in the US, not as well known here. And they essentially said, well, we think that by doing, in a way, good old-fashioned lending, really understanding the markets and the businesses, we can actually serve those needs. We believe that we can reach those businesses. But by doing that, in a way, they were sort of bucking all the trends. They were doing something that people didn't think was bankable. So it was very difficult for them, actually, to raise a sustainable source of finance. So we started working with them about 8 years ago and created something called the Community Investment Enterprise Facility. And in fact, Rebecca McDonald, who was behind the CFA certificate you mentioned, was also behind this structure. So she's got many footprints in this event. But we created a structure where we will invest in these alternative lenders to demonstrate that actually this is possible and that you can do it, with a view to then crowding in other sources of capital. So that was set up, launched about 2018, navigated the pandemic, reached about 1,000 businesses disproportionately operating in places of deprivation. this year, it seems like this year's been a long year. What we saw is actually Lloyds then came in and said, well, we want to work out how do we get our money working into these communities and places, and how can we partner with this? And now that we can see actually what's come from the track record, both of impact and of financial performance of those underlying lenders, they've now come in to support a second iteration of that fund, putting 60 million behind that and supporting the growth of the sector. So and the structure that we have there, which allows, which is across multiple different lenders, so there's an opportunity to have different areas of geographic reach, but also slightly different risk profiles sitting behind that, also allows them to deploy at scale and have that exposure geographically and in sort of different ways. So it sort of brings together quite a lot of that move first, create the right products. And the final piece I should mention, we use British Business Bank guarantees within that structure, which provides an additional level of comfort to somebody who's ultimately responsible for depositors' money, that they can actually, they're investing that responsibly. So.
There's a lot there to work with and believe in, really, really incredible. Flipping it back once more to you, Chris, looking at your capital raising experience for your fund specifically, are there any successful ways you've are there any ways you've attempted or succeeded in bringing the risk appetite of investors in line with your fund?
Yeah, so to some extent it depends on your definition of success. So we've used blended finance, so that means, as Anna described, using first loss guarantees, these different things, from catalytic providers, or even in our case, sometimes not catalytic providers, but people that are willing to take more risk in order to create less risky securities for others. The reason I say definition of success, we've done quite a bit of that, and we've brought in investors that wouldn't normally look at the space. So for example, in one of our blended finance funds, we had Allianz that took a senior tranche, basically because they were given an incredibly attractive return with incredible loss coverage above. And I think Allianz would never do something like that normally. So it's success in that sense, and I think it has served us very well in terms of building a track record. However, blended finance structures, at least in my experience, are really hard work. Trying to work together with the different needs of different parties, and we'll often have 10 different government institutions in the same vehicle, trying to make sure they don't ruin the investment mandate with all the different restrictions each of them have. The risks you have then of intertwining different tranches, and if one of them goes missing, I think is not a way that you really will scale in the end and get to something that's really sustainable. I think they're one-off, great proofs of concept, but they're tremendous work. So I think successful in that sense. In terms of going forward, what we want to try and do is try and make those, let's say, protection layers more homogeneous so that they can become more commercial. So what we've done on our latest funding is we've gone the route of a rating. So we've got an investment grade rating on our senior tranche. And so then something that looks more like you'd feel in a traditional market. I'll be honest, that's pretty much failed because everyone still looks at it and says, yeah, but you're emerging market private debt. So we don't have a low risk bucket for emerging market private debt. We want the high return. So it's a thesis that hasn't necessarily played out. But I think something along the lines of ratings, guarantees, and guarantees that become more homogenous rather than the blended finance funds, which admittedly we've done and continue to do, that are very bespoke. And yeah, ultimately will be sort of, again, in the hundreds of millions, $500 million, that sort of size each time, rather than something that really works. So I say success, kind of.
Yeah, well, a worthwhile attempt, it sounds, and hopefully in the longer term this will start taking shape and scaling and being replicated, because that could even be a way to succeed, right, by testing something and seeing that being replicated in the market. And that probably takes me nicely to the last question before we go to the audience, because we do need to start wrapping up. Does any one of you still have any final, either tested or untested innovative ideas? Perhaps even call it the magic wand, as was earlier mentioned, to further enhance the alignment between investor appetite and societal needs?
I think I probably would have to put my hand up on something there and just be very honest about the role that investment consultants have played in this. And we've heard feedback from the investor community that consultants haven't been doing enough. They haven't been prepared to do the research and do the work on first raise, no track record, new funds that don't fit the traditional box that people want to do. This is a VC, therefore we wait till fund 3 and it needs to be 50 million and we need to know that the investor's got a 10-year track record, if not here, at least somewhere else, that sort of thing. And we're testing this now, but we've spent a lot of time reflecting internally on how we approach researching these types of funds and opportunities, and are thinking about it differently. We're in a great place where we aren't the biggest players in the market, so we can look smaller, we can think about things differently, and we can work with clients to get them where they're comfortable, and we can get comfortable, and we can do the due diligence that's needed. But I think it would be fair of me to call that out for my industry as a whole, but say that that is an innovative thing that we are testing with our clients at the moment to try and force ourselves to think differently. Anna?
I think I've got a bit of a ringing endorsement actually from what Chris was just saying. So it's almost anti-innovation saying this, because it's actually about making some of this, we need to make some of this simpler and more accessible to people, and we do need to have some of these structures that are in some ways more familiar to different investors. So we need to differentiate between where we really need the innovation in the business solution, or where we need the innovation around how you tackle the social problem, and maybe where you need innovation around the finance structure, with actually, for the bits of the market we're trying to scale, how do we think about, actually we're not doing things that differently. We're sort of all protecting our sort of little areas of difference, and they're not that different. So I think actually it would be to say, I would still love to see some more of that, and I think that needs to be, for the future of blended finance, it needs to move from being a slight sort of cottage sort of industry where we're all doing it in our own way, to something where there are more commonly understood practices, tools that people can apply, because it's not the best use of people's time. There are brilliant people out there tackling the hardest problems. They're working with, children on the edge of care or in the care system. They're working with people who are homeless. They're working with people, who are going to high-cost lenders and, it's destroying their lives. They're trying to tackle those problems. Their energy should be focused on that, not replicating, syndicated loan structures that people have done before. So actually we could do with just simplifying some of that, making it easier to access, so that we can focus actually on the really big problems that we've got.
Well, we'll end on you, Chris. No pressure.
I think it's sort of carrying on and saying the same thing. I think we need to start making things more standard so that they're more familiar. And I think it hasn't happened yet, so it's something that needs to happen. Certainly, if I speak with private debt in emerging markets for impact, has not got to a point that it's mainstream enough that people won't, your mainstream investor won't sort of just not be able to invest in it because of risk perceptions that, in my opinion, will be wrong. But my opinion wouldn't have been this opinion before I got involved in it. I'd have probably had the same as theirs. So I think it's slowly doing that by, unfortunately, building track record and trying to get these structures that become more and more familiar. And again, with the private debt landscape, having things that you would imagine you have in developed markets. So you have trust structures, you have backup services, all those different things that start to make it look more and more like you're used to. I think that's the way, but I think it takes time.
It will take time. Right, over to the room. We haven't got all that long, but there's definitely space for a few questions. I see one in the back there. Perfect. Microphone on the way.
Thank you. Sahil from Tipping Frontier. To what extent does the quantitative size of the impact guide your investment decisions or the investors that you work with? And how do you compare impact metrics when they're multidimensional compared to financial metrics? So say something that benefits water security versus something that benefits pandemic preparedness. I mean, these are questions that nation states deal with when they make investments. So curious how you make those decisions.
Any one of you most go?
I'm happy to give it a go.
Yeah, let's see how we go. I'm sure others will.
No, it's a great question. So how does the size, firstly, it does guide how we try and understand, is there an investable opportunity there, and is there something that we should be focusing our time and our capital on trying to tackle, and can we also see the potential to scale the impact of that up? So that's kind of helping guide us in terms of understanding the scale of the challenge that exists, and the scale is both about sheer numbers, but it's also about the depth of that problem. So how much is that impacting people's lives? How much is that impacting communities? how much is that impacting the public purse? And when we look at some of the issues and they're costing the state huge amounts of money, as well as having really adverse impacts on people's lives. I touched on children's care being one of those. So we definitely use that as a guide to, is that a problem that we should go after and try and tackle? And then that's sort of helping to guide us in terms of thinking about what our priorities will be as an investor. We're probably unusual in the sense that, many investors and many, will have certain priorities already or thematics which matter to, which are particularly important for them. For us, it's about finding where we can create the greatest impact in the UK and aligning to that. So we don't necessarily specifically go after, particular themes, but I think there will be other investors for whom their mission is related to poverty, for example, and therefore they might choose to prioritize those areas that align to that mission. I think the question of kind of metrics, we're predominantly focused on social impact. So in a sense, sort of comparing with some of the broader environmental metrics, it does come in because we look at investments that tackle both. But it is very much about trying to have a holistic suite of measures that help you understand whether you're creating the change that you sought to change, to achieve at the beginning. So it's having that real clarity of what is the problem you're trying to tackle, what measures would actually tell you whether or not that is moving. And a lot of those are quantitative, but you also sometimes have to bring in qualitative measures, which are much more about the outcomes that people are experiencing and how does that impact tenant well-being or people's mental health, and integrating all of those. So in a way, there isn't a single answer. It's about asking what tells you what matters, and then using that to guide not just your decision at the beginning, but actually how you understand what's working along the way, but what's not working, and then iterating and guiding your future investment decisions.
Go first.
Well, I was echo a few of those points. I think when making investment decisions, it's really helpful to use frameworks, and frameworks lend themselves really nicely to having a metric or two metrics to measure a particular objective. And I think what we've realized is, although every single one of our clients, I mean every single one, has a sustainability row in their investment objectives framework, that actually the more you want to go down the social themes, the more you have to be prepared to have some more pages in your report that tell the qualitative story around the engagement themes in the public market, or the what the fund managers are telling you in the private space, and understanding that qualitative picture rather than just asking for a helpful metric that you can put in a box. But it's not what the finance world is used to, I think, is fair to say.
Well, the case studies are often the thing that then actually really engages people.
Yeah.
So all the measures in the world, but then you get one case study about how somebody's life was transformed through this. And it's interesting how that can completely switch people's mindset and make them think quite differently about what they're investing in.
So on our side, I think we have two slightly different approaches to it. One is just a threshold thing, so it's not a ranking or a comparison point. It's a threshold, and as we're predominantly focused on financial inclusion, we have an impact scoring framework that works on different dimensions, things like access, alternatives, opportunity, and that creates a threshold score. So that's on the one side, and that's kind of separate and just is required to be met in order to look at it. And then on something that I think is purely quantitative and is comparable across everything, and links impact to financial return, we're very focused on what we term unit economics. But basically what I mean is that we want to make sure that everyone in this transaction has a productive use of our capital, so that we make a return, our investors make a return. Generally we're funding intermediaries that then do lots of on-lending or creation of services at a very granular level. So to give you an idea, our database is something like 180 million individual loans, so it gets very granular beyond the level of our intermediary. And what we want to see is that our intermediary makes a return on our cost of capital, that they have a positive unit economics, and that the end beneficiary has a productive use and has a positive unit economics. And that is a quantitative number. We can look at it from all our borrowers, so it's very comparable, but it also makes just good financial sense. We're a debt provider, we're not an equity investor. We're not there for someone to try something new and to sort of grow their market share. We're there because we're creating value at every level of the chain.
Well, that was a very comprehensive answer across the board. Thank you very much. Any final questions? Conscious that we are running over time, and we're in between the audience and the drinks, so I'm sure everyone is keen to go for refreshments. Any final hands? No, great. Well, we've covered a lot of ground there. A big thank you all for sharing your valuable experience and insights. I hope you've all learned something new. I'm sure you have, and I hope you stick around for a well-deserved drink and for, I'm sure, a chat. I'm sure people will be keen to share their reflections and pick your brains on a few topics that have been discussed this evening. Before we wrap up, I'll keep it brief. I do want to have a few shout-outs. Of course, as already mentioned, A&O Shearman, incredible hosting. We will be enjoying it in a minute even more. So thank you very much for that. Someone I really would like to mention as well is our Executive Director, Antonella. I'm not sure, you're over there. She's been invaluable, not necessarily visible to everyone, but she's done a lot of work on this event, and she's actually moving on soon for a very exciting adventure, moving to Kenya. So you may come across each other, Chris. So wishing her all the best for that, and really a big thank you for your efforts on this event. In general, all the 5 board directors, the Lin associates that have been involved in running the event and the logistics tonight, running around with microphones, etc. The panelists, of course, has already been mentioned, but that's the key part of the event, and yeah, really appreciate all your insights. And then last but not least, the audience, your presence here, your time and engagement is much appreciated. If you've enjoyed tonight, do make sure you link up, if we can go to the next slide, to follow the Financial Inclusion Forum and the London Impact Investing Network. There are regular events, so do make sure you stay in tune. We have a quick survey that we'd really appreciate you, if you could take the time. It probably takes only 2 minutes. If you could fill that in, simply scan the QR code. So I should be seeing all your phones now. And then it takes you immediately also to a link to follow all our organizations. So it's a really easy way to be able to stay in touch with the content and the events that we're creating. Right, I believe that's everything covered. Hope you've enjoyed yourself and you'll continue to enjoy yourself. I think we've got a good hour so that we can stay around to have drinks and cannabis. Great.